After the last crisis, the world was told a comforting story. Banks were safer, markets were smarter, risk had been measured, priced, and tamed. The system, we were assured, had learned its lesson. But history rarely repeats itself honestly. It adapts, it disguises itself, and it waits. Because while the headlines declared stability, something quieter was happening underneath the surface of global finance. Risk didn't disappear. It moved. It slipped out of sight, into places most people weren't looking, into systems too complex to explain on television, into incentives too profitable to question. And today, long after the scars of the last crisis faded from memory, the world may be standing on a new fault line, one built not on obvious recklessness, but on silent confidence. This is the story of how modern markets learned to hide danger in plain sight, and why the next financial shock may arrive not with panic, but with disbelief. In the years following the global financial crisis, fear was everywhere. Governments rewrote rulebooks. Central banks expanded their power. Regulators promised vigilance. Stress tests were introduced. Capital requirements were raised. Balance sheets were scrubbed and audited. And for a while it worked, or at least it appeared to. Markets calmed. Volatility declined. Crashes became rare. A new belief began to take hold that the worst was behind us. Financial news shifted tone. Instead of warnings, it offered reassurance. Instead of systemic risk, it discussed opportunity. Investors were told that this era was different. Data was better. Models were smarter. Algorithms could react faster than humans ever could. The system, people said, had evolved. But evolution doesn't always mean safety. Sometimes it just means complexity. And complexity has a dangerous side effect. When something breaks, no one knows where or why. In past crises, danger had a face. It was bad loans, over-leveraged banks, speculative bubbles that anyone could point to. But modern risk doesn't announce itself that way. Today, it hides behind words like efficiency, liquidity, and innovation. Financial products are no longer designed to be understood by the public or even by many professionals. They are designed to function until they don't. Risk has been sliced, repackaged, redistributed, and sold across borders in milliseconds. No single institution holds enough exposure to feel responsible. No single regulator sees the entire picture. And that is precisely the problem. Because when everyone owns a small piece of the risk, no one feels accountable for the outcome. This is how danger survives in modern markets. Not by being ignored, but by being fragmented. One of the great promises of modern finance is liquidity. The idea that you can always exit a position, that there will always be a buyer, that markets are deep enough to absorb stress. But liquidity is not a permanent feature. It is a mood. It exists when people are confident and vanishes when they are not. During calm periods, liquidity feels infinite. Assets trade smoothly. Prices adjust gently. But under stress, liquidity doesn't fade gradually. It collapses suddenly. Buyers step back. Sellers rush forward. And markets that once seemed stable begin to gap violently. This has happened before repeatedly, and yet each time the system convinces itself that this time is different. Because the danger isn't in the asset itself. It's in the assumption that someone else will always take the other side. Leverage has always been at the heart of financial crises. Borrowing magnifies gains, and it magnifies losses even faster. After the last crisis, leverage didn't disappear, it just changed form. Instead of sitting visibly on bank balance sheets, it moved into shadow banking systems, hedge funds, private credit markets, derivatives structures, repo, and collateral chains. These areas operate largely outside public view. They don't publish the same disclosures. They aren't stress tested in the same way. And they depend heavily on trust. Trust that funding will roll over. Trust that collateral will hold value. Trust that volatility will remain contained. As long as confidence holds, the system appears strong. But when confidence breaks, leverage doesn't ask for permission. It forces selling. It amplifies moves. It turns small shocks into systemic events. In every modern crisis, central banks have stepped in as saviors. They cut rates. They inject liquidity. They calm markets with words and with balance sheets. Over time, markets learned something important. Central banks will not allow collapse. This belief became embedded in prices. Risk premiums shrank. Speculation increased. Why worry about downside when rescue feels guaranteed? But this creates a paradox. The more central banks intervene, the more markets depend on intervention. And the more dependent markets become, the less resilient they are without it. What happens when inflation limits rescue? When political pressure constrains action? When credibility itself comes into question? The tools that once saved the system may not always be available or effective. Modern markets move at speeds the human mind cannot process. Algorithms trade in microseconds. Decisions are executed automatically. Feedback loops form instantly. Speed brings efficiency, but it also removes reflection. When something goes wrong, machines don't pause to ask why. They react. They sell because prices fall. Prices fall because they sell. And within seconds, rational markets can become mechanical avalanches. This isn't theory. It has already happened. And each time, the system promises it has learned. But learning requires understanding. And understanding requires slowing down. Modern markets rarely do. Perhaps the most dangerous force in finance isn't greed, it's familiarity. When people grow accustomed to stability, they stop preparing for disruption. Warnings sound exaggerated. Skeptics seem outdated. Caution feels expensive. This is how risk returns, not with excitement, but with boredom. Because the most dangerous moments in markets are the ones that feel quiet. When volatility is low, when narratives are comfortable, when everyone agrees. That is when systems stretch invisibly. That is when assumptions harden into beliefs. And that is when a single unexpected event can expose everything at once. The next crisis will not look like the last. It won't come from the same place. and it won't arrive with advance notice. It will emerge from confidence itself, from systems designed to be efficient, from safeguards built on past mistakes, from the belief that we are smarter now. History suggests otherwise. The most dangerous risks are rarely the ones people argue about. They are the ones everyone quietly assumes are handled. Because when an entire system agrees that something is safe, questioning it feels unnecessary, even irresponsible. And today, some of the largest risks in global finance live inside places described as boring, stable, or well understood. They aren't flashy. They don't trend on social media. They don't panic retail investors. They sit patiently until they don't. For decades, banks were the heart of the financial system. That's where leverage lived. That's where risk accumulated. That's where crises exploded. But after the last collapse, banks were forced to shrink. Capital rules tightened. Oversight increased. Risk-taking became expensive. So finance adapted. Risk didn't disappear, it migrated. Today, a massive portion of global financial activity happens outside traditional banks, in a loosely connected network often referred to as the shadow system. This includes asset managers, private equity funds, hedge funds, money market funds, private credit lenders, and structured investment vehicles. These institutions don't look dangerous. Many are respected. Some manage retirement savings and pensions, but together they now rival and in some cases exceed banks in size and influence. And unlike banks, they are bound together by confidence, not capital guarantees. One of the fastest growing corners of modern finance is private credit. Loans made outside public markets. Deals negotiated quietly. Risks priced without transparent benchmarks. Private credit grew because it solved a problem. Companies wanted funding without public scrutiny. Investors wanted yield without volatility. Banks were restricted. So private lenders stepped in. At first, cautiously, then aggressively. Today, private credit manages trillions of dollars, and much of it is built on assumptions that have never been tested under real stress. Assumptions like borrowers will always refinance, asset values will hold, cash flows won't suddenly disappear. But history teaches us something uncomfortable. Stress doesn't arrive politely. When economic conditions tighten, refinancing vanishes, cash flows dry up, and assets once thought stable reveal their fragility. The danger isn't that private credit exists. It's that it expanded during calm years, under the belief that calm was permanent. Modern finance is not a collection of isolated risks. It's a web. One institution lends to another, which posts collateral borrowed from a third, which hedges exposure with a fourth. Each link appears reasonable on its own, but together they form chains of dependency. When everything works, the system hums quietly. When one link weakens, tension spreads invisibly. This is how small problems become systemic, not through panic, but through obligation, margin calls, collateral demands, funding withdrawals. And because these chains are opaque, no one sees the full picture until stress forces transparency. By then, reaction replaces planning. Diversification, is one of finance's most comforting ideas. Spread risk widely enough, and no single failure matters. But diversification only works when risks behave independently. In modern markets, they don't. Assets that appear unrelated often respond to the same forces: liquidity conditions, interest rates, investor sentiment, policy decisions. When stress arrives, correlations rise. Everything moves together. Portfolios built for balance suddenly tilt in the same direction, and investors discover that diversification didn't remove risk, it simply delayed recognizing it. For all the complexity, finance is still human. Decisions are made by people. Trust is extended by people. Confidence is lost by people. And human behavior under pressure hasn't changed. When uncertainty rises, people protect themselves first. They sell what they can, not what they should. They pull funding, even if it destabilizes others. They assume survival requires speed. This behavior isn't immoral, it's natural. But when millions act this way simultaneously, systems fracture, and the mechanisms meant to distribute risk become channels that concentrate it. Crises don't announce themselves clearly. They whisper, through small disruptions, through unusual correlations, through moments when markets behave strangely but briefly. Most of these signals are dismissed. They're explained away as anomalies, temporary imbalances, one-off events. But history shows that before every major collapse, there were warnings that felt inconvenient rather than urgent. And inconvenient warnings are easy to ignore. Every generation believes its systems are more advanced than the last. That belief is comforting. It suggests progress, control, mastery. But complexity doesn't eliminate fragility. It often hides it. The more layered a system becomes, the harder it is to understand, and the more surprising its failure will be. The next crisis may not involve banks collapsing overnight. It may look slow at first. A fund freezes withdrawals. A market loses liquidity. A credit channel quietly shuts down. And only later will people realize those were not isolated events. They were symptoms. Time dulls memory. As years pass without disaster, caution fades. Rules loosen. Standards bend. Assumptions harden. This isn't corruption. It's forgetting. Forgetting why safeguards exist. Forgetting how fragile confidence can be. Forgetting that stability itself is temporary. Every major financial collapse was preceded by a period of belief that collapse was impossible. None of this means collapse is inevitable, but it does mean that certainty is dangerous. The systems that power modern finance are powerful and fragile. They work because people believe they will, and belief, once shaken, is difficult to restore. The next shock may not come from reckless greed. It may come from quiet confidence, from systems built to optimize but not to endure. The question isn't whether risk exists, it's whether we recognize it before it forces recognition upon us. Because history has shown, again and again, risk ignored doesn't vanish. It waits. Because once trust breaks, no amount of liquidity can repair it quickly. Welcome to Cash and Chronicles, where money, power, and history collide.